Bonds represent contractual loans to corporations and governments. The advantages of bonds are that they provide low-risk, fixed income in the form of interest payments. They also include a tax incentive for the companies that issue them, and they help investors diversify a portfolio. Asset allocation is an approach in which you include different investments into one portfolio. Diversification means to spread your investments across different types of assets to manage financial risk. This protects you against significant financial losses. So by spreading your investment money across more than one asset category, you can reduce risk and improve returns. The face value or par value of the bond is the amount of money that the bond issuer will pay to the bondholder on the maturity date. Typical par values are $1,000 or $100. The maturity date of the bond is the length of the loan contract, which could be a few months, a few years, or even decades in the future. Just like a stock, you can sell a bond at any time before it matures. Remember, though, that if you sell a bond before it matures, then you will receive the fair market value of the bond, the price that you can sell the bond to another investor, not the face value, which most likely will be different than your initial investment. The coupon rate of the bond is the interest rate that the bond issuer has agreed to pay the bond holder. Coupon rates can be fixed or variable over the life of the loan. The coupon payment for the bond is the dollar amount of interest that the bond issuer will pay the bond holder. Coupon payments generally occur twice per year, but they may be more or less frequent. Corporate bonds generally offer investors a higher coupon rate and often a longer maturity date. Federal government bonds are similar to U.S. savings bonds, but different in significant ways. Treasury securities with a maturity date of 1 year or less are called Treasury bills or T-bills. Treasury securities with a maturity date of 1 to 10 years are called Treasury notes, and then Treasury securities with a maturity date of 10 to 30 years are called Treasury bonds. The U.S. Treasury Department is responsible for selling most federal government bonds to investors. T-bills do not have coupon payments. Instead, they are purchased at a discount from face value, with the interest earned being the increase in value from the purchase price to the face value over the holding period. These are called zero coupon bonds because the bondholder does not receive interest directly. So there's no coupon payment. Both Treasury notes and Treasury bonds make semi-annual coupon payments. States, counties, and cities also borrow money. Bonds issued by states and local governments are called municipal bonds. Funds are typically used to develop and maintain infrastructure, so that would be roads, buildings, parks, schools, and police and fire departments. All interest earned is tax exempt at the federal level. The risk that a company or a government may not be able to repay the bond is called default risk. A rating agency analyzes corporations and governments' ability to repay debts. Two well-known rating agencies in the United States are Standard & Poor's and Moody's. These rating companies evaluate companies and governments as follows. Those with the highest probability of repaying their debts are rated as AAA, if it's S&P that's rating them, or AAA if it's Moody. Those with low probabilities of repaying their debts are rated as C. Those that are unable to repay their debts are rated as D for default. If you don't want to hold a bond until its maturity date, you may be able to sell it to another investor. The factors that will affect how much you will receive for the bond in the secondary market include its current interest rate, the coupon rate, and the fair market value. An important rule to remember with bonds is that there is an inverse relationship between current interest rates and the fair market value of the bond. If current interest rates fall and are less than the coupon rate, then the fair market value of the bond will rise to an amount greater than the face value of the bond. The reason for this is because if current interest rates fall, that means then that newly issued bonds are going to be issued at a lower coupon rate. That makes those existing bonds more valuable and therefore makes the price or the fair market value of those bonds rise. So if current interest rates rise and are more than the coupon rate, then the market value of the bond will decrease to an amount less than the face value of the bond.